All right, let's talk about something really weird that happened in the markets. We had this huge stock market rally. I mean, a fantastic day for most people. But at the exact same time, the tech world was basically in a total meltdown. So, how on earth does that happen? Let's get into it. Yeah, this is the big question, right? You've got this wave of pure optimism lifting one part of the market, and then this deep, gnawing fear pulling the tech world in the complete opposite direction. It really is a tug of war for the soul of the market, and trying to figure out which side has the upper hand, well, that tells you a lot about where we might be heading. And you can see that split personality right here. On one side, you have the Dow, which is kind of like the pulse of the broader economy. It's up almost 500 points, just soaring. But then look at the tech-heavy Nasdaq. It's taking a serious nosedive. We're talking two totally different stories being told on the very same day. So let's start with the good news. What in the world was fueling that big rally? Well, all that optimism, it really came down to one of the most powerful players in the entire financial world, the U.S. Federal Reserve. I mean, you know how it is. The market hangs on every single word the Fed says. And on this particular day, they heard something they absolutely loved. And boom, this quote right here was the spark. A top official from the New York Fed gave what traders call a dovish signal. Now, that's just some market jargon for basically hinting that interest rates might be coming down soon. And you know what that means, right? It could get cheaper to borrow money for businesses, for you, for me, and that usually juices the economy. This one little comment was all it took to kick off a massive buying frenzy. And when I say the reaction was immediate, I mean it was dramatic. Just look at this. On Thursday, traders were thinking, a rate cut, maybe a 40% chance, less than a coin flip. But by Friday, after that comment, whoosh, that probability skyrockets all the way to 70%. That is a huge swing in confidence, practically overnight. But here's the crazy part. While most of the market was celebrating, the tech sector was feeling, well, pretty sick. Okay, so let's flip the coin and look at the other side of this bizarre story. While the Fed was busy lifting everyone's spirits, this deep anxiety was just pulling the entire tech sector down. And it's a fear that's been bubbling under the surface for a while, and now it's finally boiling over. People are calling it the AI capital reckoning. So what does that even mean? Well, the core fear is all about overspending on AI. For the last couple of years, the mantra in tech has been growth at any cost. Invest billions in AI, build these enormous data centers, we'll figure out how to make money later. But the mood has totally shifted. Investors are now looking at these companies and asking a really tough question. Okay, where's the profit from all this spending? They're done with the hype. They want to see a real return on that investment. And you can see that new attitude in action right here in the numbers. The market is getting super picky. The overall Nasdaq index is down more than 6%, right? But look at the individual companies. Alphabet, Google, is actually up because it's starting to show how its AI is actually making them money. And Apple is holding its ground because, well, they're famous for being smart and disciplined with their cash. The message from Wall Street could not be clearer. Show us the money, not just the cool science projects. And this whole tug of war between hype and reality, between spending big and actually making a profit, that's not just a tech story here in the US. It's a drama playing out all over the globe, just in different ways. Let's take a quick look around the world and see what I mean. So if we head over to the UK, you've got this £500 million deal to buy the Telegraph newspapers. I mean, it's a massive financial power move, right? But it immediately smacks into a wall of regulatory scrutiny. People are worried about too much media power ending up in the hands of just a few. It's a perfect example of a huge, expensive bet running headfirst into a reality check. Then let's jump over to Nigeria, where you see a very real crisis of confidence in the country's economic policy. The unofficial parallel market rate for a US dollar is way, way higher than the official rate. And that gap, that's a huge red flag. It's basically the market shouting that the government's policies aren't working, and it has real consequences for everyday people dealing with inflation. And now for something completely different. As a total contrast to all that volatility in tech, check this out. Kimberly-Clark, the company that makes stuff like tissues and diapers, just announced its quarterly dividend. Big deal, right? Well, they've now increased that dividend for 53 straight years. In a market that's getting super nervous about risky bets, that kind of rock-solid stability, man, that starts to look incredibly attractive. And finally, let's bring it back to the US. A top government official basically laid it all out there. He said that this whole race for AI, for batteries, for computer chips, it isn't just about which company makes the most money. It's a matter of national strategy, of geopolitics. It really drives home just how high the stakes are for all that AI spending we were just talking about. Okay, so we've looked at the Fed, we've looked at the AI panic, we've taken a quick trip around the world. So what's the big picture here? What does this one crazy day in the market really tell us? Well, it all boils down to one simple but super powerful concept. And that is the difference between sentiment and fundamentals. Think of sentiment as the market's mood. It's emotional, it's driven by news, like the hope for a Fed rate cut. That whole rally was pure sentiment. But fundamentals? That's the real stuff, the underlying financial health, the actual profits of a company. And that concern over AI spending, that was all about the fundamentals. So what are the key things to walk away with from all this? First, you got to remember that the modern market is this constant tug of war between short-term feelings and long-term facts. Second, especially in the tech world, the game is changing. It's not about growth at any cost anymore. The new winners are the ones with capital discipline and proven profits. And finally, this same tension between immediate risk and long-term value, it's not just on Wall Street. You can see it everywhere, from media deals in London to currency markets in Lagos. And there you have it, the tale of two markets. Hey, if this explainer helped you make a little more sense of the crazy headlines, do us a quick favor, hit that like button, share it with someone who might find it useful, and of course, subscribe so you don't miss the next one. And we really do want to hear from you, so drop a comment below and let us know what topic you want us to break down next. Thanks for tuning in.